In this video, we will walk through the main tax options available to sole proprietors in Denmark and help you think practically about which scheme may fit your situation best. Whether you are a consultant, freelancer, craftsman, or running a small online business, the way you choose to be taxed can impact both your cash flow during the year and your long-term wealth building. We will focus on 3 core elements: how personal income tax works for sole proprietors, what distinguishes the standard personal income taxation from the business taxation scheme, and which criteria you should consider when choosing between them. As a sole proprietor in Denmark, your business is not a separate legal entity. Instead, your business income is taxed together with your other personal income, such as salary, interest, or investment returns. By default, your profits are treated as personal income after certain deductions, and you pay tax according to the progressive Danish tax rates, including municipal tax, health contributions, and, where relevant, top bracket tax. This standard approach is straightforward, requires relatively simple bookkeeping, and is often suitable for smaller activities or those with modest or fluctuating profits. Under the standard personal income rules, you deduct your business expenses from your business revenue to arrive at a taxable profit. You can also make use of general tax deductions, such as personal allowances and certain pension contributions, but you do not gain access to the more advanced tools designed specifically for business owners to manage income across years or to separate business and private finances in a more structured way. For many first-time sole proprietors, this simplicity is attractive: less administrative burden, fewer technical choices, and a lower risk of making mistakes. However, as your profits grow or become more stable, it may be relevant to consider the business taxation scheme known in Denmark as virksomhedsordningen. The business taxation scheme gives you the option to treat your business more like a separate financial unit for tax purposes, even though it is not a separate company. Under this scheme, you can deduct interest expenses at a more favorable rate, retain profits in the business at a relatively low flat tax rate, and control how much income you withdraw to your personal finances each year. This gives you more flexibility to smooth your personal income over time and can help you avoid or reduce top bracket tax in high profit years. To use the business taxation scheme, you must meet certain bookkeeping and reporting requirements. You need to keep clear separation between business and private finances, maintain proper accounts, and submit specific statements to the tax authorities each year. The administrative burden is higher, and you may find it worthwhile to engage an accountant to ensure compliance and to optimize your use of the scheme. This cost should be weighed against the potential tax benefits. Another key concept is the ability to retain part of your profit within the business at a favorable rate. Instead of withdrawing the full profit and paying personal tax immediately, you can choose to leave some profit in the business, where it is taxed at a lower business rate at the time of retention. Only when you later withdraw that retained profit as personal income do you pay the remaining tax, adjusted so that overall you end up at approximately the same final tax level as if everything had been paid out immediately. The value lies in timing. By choosing when to withdraw profits, you can plan around years with other high income or around future investment needs in the business. This flexibility is particularly relevant if your income is volatile, for instance in consulting, project-based work, or seasonal trades. If your annual profit varies significantly, the business taxation scheme can allow you to avoid being pushed into higher tax brackets in a few exceptional years, balancing your overall lifetime tax burden. In contrast, if your income is stable, relatively modest, and you withdraw nearly all earnings each year for personal living costs, the benefits of the business scheme may be limited. In that case, the standard personal scheme might remain more practical and cost-effective. A related option, often discussed in the Danish context, is whether it makes sense to move from sole proprietorship to a company structure such as an APS. While this is technically outside the narrow theme of tax options for sole proprietors, it is something that naturally comes into the decision-making process once your business reaches a certain scale or risk level. Company structures can provide limited liability and a different set of tax and dividend rules, but they also come with stricter capital and reporting requirements. For many small sole proprietors, it is more pragmatic to first optimize within the existing sole proprietorship framework, choosing between the standard taxation and the business taxation scheme before considering incorporation. When deciding which tax option fits you, there are several questions to ask yourself. First, what is the level and stability of your profits? Higher and more stable profits increase the value of income smoothing and tax planning. Second, how comfortable are you with administrative complexity, or are you willing to pay for professional support? The business taxation scheme can be highly beneficial, but only if it is implemented correctly, with clear separation of accounts and consistent documentation. Third, what are your investment plans for the business? If you intend to reinvest a portion of your profits into equipment, marketing, or expansion, the ability to retain earnings at a favorable rate inside the business becomes more attractive. Fourth, what is your broader financial situation, including other income, pension savings, and personal tax position? Your optimal scheme cannot be evaluated in isolation from the rest of your household's finances. In practice, a typical path for many Danish sole proprietors looks like this. In the initial years, they use the standard personal taxation scheme to keep things simple while the business model is still being tested. As revenues grow and stabilize, and as the owner begins to think about long-term wealth building, they consider moving into the business taxation scheme to gain more control over timing and to access more advanced tax tools. At each stage, an annual review with an accountant or tax advisor can help ensure that the current scheme still matches the business's size, risk profile, and the owner's personal goals. As you evaluate your own situation, it is important to remember that the best tax scheme is not the same for everyone. If you are early stage, side hustling alongside a salaried job and generating modest profits, simplicity and low administrative burden may be your top priorities. If you are running a more mature business with significant profits and a long-term horizon in Denmark, greater sophistication in your tax planning may unlock meaningful savings and improve your ability to invest in growth. As tax rules can change and individual circumstances differ, you should always verify current thresholds, rates, and conditions with official Danish tax guidance or a qualified advisor before making a final choice. By understanding the fundamentals of how your income is taxed as a sole proprietor, and by aligning your choice of scheme with your income level, volatility, administrative capacity, and investment plans, you can position your business on a more solid financial footing. This not only supports compliance with Danish tax rules, but also helps you use the available frameworks to your advantage, so your efforts as a sole proprietor translate more efficiently into long-term financial security.